Well, thank you for coming back to You Heard It from a CFP. My name is Matthew Coyle. Today is November 19th, 2021, and today we're going to talk about advice, my advice for young investors. Let's dive in. All right, well, this video was actually prompted by an email that I received from a young investor that I happen to know personally that reached out to me and said, hey, I've just inherited a little bit of money. What should I do with it? I've never really invested before. This person's in their 20s. And they don't want to make a mistake because they've never really dealt with it before. So I thought, let's just make a video out of it and throw out there some tips for young investors who want to get their money in the market or how to manage their finances a little bit better. So number one, and the first thing I told this person to do, pay off small debts first. If you're looking to invest, but you've got $1,000, $2,000, $3,000, $5,000 sitting on credit cards at 15, 16, 17, 18%, you need to get those paid off immediately if you have the ability to do it. You can't invest at 8, 9, 10% and expect to pay off debts at 15, 16, 17, 18%. The math just doesn't work. So take some of the money you've either inherited or saved up or whatever, however you came into it, and use that to pay off small debts first. That would be number one. All right, number two, be thankful. It's almost Thanksgiving, so let's be thankful for something. Be thankful that you, as a new investor, can put money to work very cheaply and very easily. It has never been cheaper and easier to invest money than it is right now. My first trade back in 1998 when I bought stock for the very first time, I remember it very clearly. It was a company called Globecom Systems back in 1998, traded under the ticker GCOM, and I paid $106 commission on one trade of stock back in 1998, which seems like a lifetime ago, but that number, that $106 commission, would be absurd and laughable by today's standards. Nobody would ever pay that for a commission on anything nowadays, let alone a stock transaction, pretty much. So be thankful you can put money to work at a very cheap rate. I would tell you, automate, pick a good, easy to understand and easy to execute investment service. We happen to use Schwab Investment Intelligent Portfolios as our platform for automated investments and passive investing. We like it. There's others out there. It's not the only one. I would say get your money to work in a easy to implement automated investment plan that focuses mainly on inexpensive passive ETFs or mutual funds for now. And then as you build up your wealth, you can layer in some more complicated investments later when taxes become a concern and other things become a concern. So for now, be thankful you can get that money into the market cheap and do it quickly and do it right away because your growth will compound. All right, number three, take risk while you can. It's okay to take risk as a young person, it's fine. I meet a lot of young investors who are nervous to be in the market because they're just old enough to remember 2008, or maybe their parents told them about it. They obviously remember the coronavirus crash, 2020. I've been in the business for 20 years. I've been around since the 1998 Asian currency crisis, 2000 bubble, 2002, 2003 bear market, 2011 correction, 2015 correction, 2018 market. I remember, of course, the coronavirus crash, 2020. I remember 2008. You should just expect as a young investor that you are going to lose 30% of your money at least twice in your career. That's just going to happen, and that's just part of the business of being in the market. Young people under the age of 35 have no business investing in CDs. They really have very little business investing much at all in bonds. They have no reason to invest in any cash or short-term security like a CD or a repurchase agreement or anything cash-related or short-term. You should be in the market. Just expect to have volatility. It's okay. You've got time on your side. Now, if you're 65 or 70, that's a different story. But if you're say 25, 30, 35 years old, the majority of your money needs to be in the market and needs to be what they say at risk. But that's okay. Over the long term, it's going to benefit you. And just by having a small 3 or 4 percentage point difference, that can mean hundreds of thousands of dollars to you in the long term, especially if you start when you're in your 20s. So get that money in the market. Don't worry about volatility. You're fine. Just get the money in and keep it funded, and just expect, again, it's going to be 2 or even 3 times in your career you're going to lose possibly over 30% by investing in the broader market. And when you do, when the market takes that big dive, you need to just put as much as you can in and lower your average cost and bring your balance up and compound even faster. So make sure that you do that. Don't be afraid of volatility. Volatility can be your friend. All right, number 4, remember why you're doing this. I meet a lot of investors who periodically will forget what the bigger picture is. Why are we investing? What is this money for? What's the purpose of this money? From a planning perspective, ducking in and out of the market and going to cash and going back into the market, going back to cash, that's not going to benefit you. The success rate of doing that is very, very, very small. The odds of you being successful at that are very, very low. Cash from a planning perspective is actually the riskiest investment you could hold because it won't get you anywhere. You are not going to achieve your goals by holding low-risk assets or cash. You need to be invested in the market over the long term. Time in the market is better spent than trying to time the market. Very simple, and the data is very clear about this. Now, you might want to move into different sectors or try different asset classes within the market. That's being tactical, but that's not the same thing as jumping in and out of the market. So, from a planning perspective, remember why you're investing this money. What is the purpose of these dollars? And don't forget the bigger picture and the long term here, all right? Time spent out of the market will just cost you money, and it won't get you where you want to go. So, don't be afraid to take risk. Pay your small debts off first. Make sure you understand the odds of success are in your favor. Remember, the market's usually positive 3 years out of 4 on average. So the odds of success are in your favor long term. Don't forget those basics. As a new investor, that will take you a long way. And as you grow, you can add more layers to your wealth if you need to do it at that time. You can worry more about taxes, you can worry about distribution strategies, you can worry about other things. But in the meantime, for a young investor just starting out, or if you're just starting out in general, get some money into easy to understand, cheap, mostly passive growth investments. Keep your debt low, keep your costs low, and just understand why you're doing what you're doing. And I think that will help for most people get them started anyway. If you have questions on other strategies or things you want to talk about, please feel free to reach out to us. We are available anytime. So thanks again for watching, and I will see you next time. Thanks.